Hi everyone, we're here with Kevin Gomer, Director of Nicheliving Wealth and Finance, and he's going to take us through the Keystart Serviceability Calculator. This is an exercise only, obviously, and is for internal use only. Just showing you how you might use the Keystart Calculator to give a generic client an idea of their borrowing potential with a low deposit loan product such as Keystart. Kevin.
Hi guys. Today we're going to go through Keystart. For those of you that don't know who Keystart is, they're a government lender that helps first time or second time buyers into the market with a very low deposit. Minimum genuine savings would be 1%. So i.e. if you're looking at a package price of $340,000, you need a minimum of $3,400 in genuine savings built up over a 3-month period. Fantastic lender for first time and second time buyers that are or don't have large deposits and don't want to pay fees like lender's mortgage insurance and what have you. So I guess today we'll just give you a bit more of an explanation of how the calculator works. This is only so you can understand the different borrowing potential through Keystart, which is substantially lower than what a mainstream bank would do. And again, if you've got any questions, we'll be able to run you through these and give you a better understanding of how Keystart works. So we'll quickly shoot through an example. We've got a couple with 2 dependents, and the 2 financial dependents will be aged 4 and aged 7. This couple both are currently working. Applicant 1 is on $70,000 per annum before tax, and applicant 2 is on $15,000 per annum before tax. Again, as you can see from the drop down box, if we've got an estimated weekly, fortnightly, monthly or annual figure, that can be put in and it'll spit it out an annual amount. So we've got the income. As you would see, because of the family tax benefit has now been added in. For those of you that don't know what family tax benefit is, it's a Centrelink income to parents that have kids under the age of 15 that have an income threshold under the national average, and they get obviously some help from the government. That income is tax-free and they don't pay tax on it, which increases the borrowing potential. Over here we've got a couple of liabilities or debts. They have a credit card with a current outstanding and limit of $9,000. The minimum repayment would be 3% of that $9,000 or $270 per month. And they also have a car loan with an outstanding balance of about $12,000. And the minimum repayment we've been told is $350 a month. For this example, they're looking at acquiring a house and land package. So they're going to be going through construction. The land amount is $170,000, and the construction with all variations and everything else is another $170,000. We're looking for a total loan amount of $330,000, of which the loan repayment would be coming up here of $1,803. So as you can see, if I change that to $334,000, which is what their maximum loan amount is calculated to be, the repayment will jump up to $1,825. The clients have got their own funds of $3,400, which is 1% of the total package price. They are entitled to the first homeowner grant, which is currently at $10,000. And in this example, we again prompted here that they've got genuine savings of the $3,400 built up over a 3-month period. Again, this is just very generic and general to give you some sort of understanding, and you can compare this to the Genworth calculator which we did earlier, which will give you a totally different borrowing potential amount. But in this example, it'll give us a good idea of a first home buyer that's entering into the market, or a second time buyer re-entering into the market that have a smaller deposit and would like to utilize the current $10,000 first homeowner grant to complete the purchase.
Excellent. Just one point, could you just quickly run over with us, Kev? Just here, this debt to income ratio, that can quite often be a little red flag when you're presenting to clients. Can you quickly tell us about that?
Yeah, so again, with the debt to income ratio with Keystart, that has to be under 10%. So if, just for example, if we pop this up to $450 a month, and we pop that one up to, say, $400 a month, you'll see that goes to 11.1%, and more noticeably, we've then got a warning sign that's popped up to say monthly commitments exceed 10% of accessible income, which means that their net income has to be greater than 10% of their expenditure. Or, sorry, the expenditure is not allowed to be 10% greater than what their net income is.
Mm-hmm. So this would be an opportunity in the presentation to have a chat about how we might, Nicheliving Wealth and Finance might be able to assist in bringing some of those repayments down to get them down below the 10%.
That's correct. And again, as you can see, if the repayments were the 400 and the 450 that we previously stated, and I'll just go back to that to change it, you'll see the borrowing potential decreases quite significantly.
Mm.
And this is an example, they would not be able to effectively purchase the package that they're after. But if we were to reconsolidate or re-look at their expenditure and get it down to what the minimum repayments would likely to be, that obviously increases their borrowing potential quite significantly. This is another advantage that Nicheliving Home Loans can offer to our clients and allow them to discover home ownership.
Excellent. Thanks, Kev.
No worries.